Marketing with Homes by WestBay, and I'm happy to be serving as the 2021 TBBA president. Although TBBA has been bringing you virtual economic updates throughout the year, this is our annual economic forecast, a look ahead at key indicators that will impact our business. And in this next hour, hopefully you will learn valuable information to help you in your business. That's our goal. But first, Jennifer Motsinger is going to share a quick update on what's going on here in Tampa.
Well, good morning, Brian, and good morning, everybody. Today's program is brought to you by a group of dedicated members of the TBBA, and I appreciate all that they do for us on an annual basis. Of course, our presenting sponsor, Eschenbach Land Company, Carpenter Contractors of America, WRA, REPA and Associates, the Castle Group, Sightline Building Solutions, BB&T, which is now Truist, Suncoast Credit Union, Clearview Land Design, Stantec, and Home Team Pest Defense. Thank you so much for all you do. You know, as a not-for-profit, TBBA is only able to continue our efforts of advocacy and education through our fundraising efforts. And we are so excited to have so many people participating in this year's Parade of Homes. Over 25 builders are participating this year. And we have a new category because we mirror what's going on in the industry. And as you can tell, in this area, there are a lot of high rises going up. So I'm pleased to introduce, if you haven't already been told, we have a high rise condo category this year. So very excited about that. I'm very proud of the sponsors for the parade: Mid-Florida Credit Union, Allied Building Solutions, Duke Energy, and I'm really excited to tour the showcase community that I've been hearing so much about, Hawkstone by Homes by WestBay. Thanks again for your sponsorship and all of your support. So here at home, I have been focused on level of service issues. You have all done such a great job managing a pandemic, along with the growth in demand for building homes, and it's certainly not too much to ask of the regulatory community to make similar adjustments, especially since you're paying for the service. That said, the regulatory community does face some challenges beyond their control, and they may not always have the resources or the technology to pivot in their business quite as quickly as we do. In the city of Tampa, building permits and inspections have been conducted electronically for years. However, we're still experiencing a lot of issues related to development, and that's typical of what you see in cities with a lot of redevelopment and population imbalance. But more concerning are some of the policies that are being contemplated that, while are well-intended to enhance resiliency and deal with climate change issues, they could have unintended consequences. In Pasco, we were successful in getting a temporary incentive of eliminating the $600 administrative fee for the use of private providers. However, that is just a first step in the right direction. They are working with us on process changes that hopefully will release the log jams that you see in building permits very soon. I'm happy that after a decade of starts and stops, Hillsborough is finally launching Acela on Monday. Yay! And this should do a lot to create streamlining in the process, especially in intake, for example. But I'm most concerned about the Hillsborough commissioners, who still appear to not be able to reach consensus on a number of issues related to growth. After well over a year of meetings on the moratorium, studies, tons of professional advice, tons and tons of information, they're still more divided. It appears that they're more divided anyway. And I expect to see some downzoning as a result. They continue to search for answers to problems like how to fix road improvements or how to do road improvements, how to address water quality issues, while simultaneously removing a lot of the revenue streams that are available to them. Yeah, they're not just imposing moratoriums and denying your projects, though. Take heart, members. They're also denying the building of schools. And I know that it's so unfortunate to see that some commissioners meet information given to them by with such skepticism and such mistrust, and they read scripts because they're not familiar with what they want to talk about, and they may not be well versed in the topic, or maybe they're just acting from a place of fear. But I can guarantee you this: stopping people from building homes and denying new schools being built does not solve a problem. It creates two of them. So last year we learned that 100% virtual environment comes with its own adjustments. I do expect process improvements to continue. However, they won't happen instantaneously. So I implore you to please continue to be courteous, professional, and patient. Please continue to work with the regulatory staff. You know, we do have meetings with all of the municipalities and their professional staffs on a monthly basis. So make sure that you're trying to attend those meetings. I know that they are difficult, but they are virtual. And if you can't attend, have somebody in your company attend, just to stay on top of what's going on, and little nuances that'll get you through the process much quicker. And all of that information can be found on our website. And you can always call TBBA's offices, and somebody will be able to help you find what is applicable to you. So with that, I will turn it back over to Brian to get started with the program. Thanks, everybody.
All right, thanks, Jennifer. Today's program includes key insights that will give us solid facts as well as comments on what we might expect in the future. I hope this information will help you navigate the economic climate and lead to a prosperous 2021. Following the presentation, we will provide the opportunity for questions. So please insert your questions in the Q&A section on the toolbar. For comments in virtual connection, please use the chat feature. Joining us today for the very first time is Chief Investment Strategist Brent Schutte with Northwestern Mutual Wealth Management Company. Schutte is responsible for Northwestern Mutual's retail investment philosophy through investment policy, asset allocation, and research. He is a frequent expert commentator on national news outlets, including CNBC, the Wall Street Journal, and Bloomberg. Thank you for joining us today, Brent.
Thanks for having me. Do you want me to launch right in?
Yeah.
Okay. All right. So thank you all, and thank you all for joining in. And you know, when I woke up this morning, I was thinking that, you know, the pandemic has had some benefits from a reduced travel schedule for me. So I do have 2 young children. But I have to admit, when I woke up to a Milwaukee morning around 30 degrees with snow on the way, and looked at your weather in Tampa, which I see somewhere around 68 degrees, this was one of those mornings that I wish I was probably in your neck of the woods for a live presentation to soak in some vitamin D. But maybe it's more appropriate that I'm actually here in my basement in Pewaukee from my own home to present to you. So as Brian mentioned, I'm going to paint a really big picture of the national economy in 2021. So we're going to discuss all the things that are pertinent to you, I think, from the standpoint of the Federal Reserve, interest rates, and then I'll turn it over to Lesley, who I believe will take you through the regional housing market. I'm not going to just focus on the economy. So as Brian mentioned, my job here at Northwestern Mutual is to tie that to a market outlook. And so given that we manage a couple $100 billion in client assets, I will have some market commentary within this. And I do believe that the two are linked at the hip, which we're going to have as a theme throughout this. And so I will take you through, and I suppose you are getting a 2-for-1, a bit of an economic outlook with some market comments, which hopefully is helpful for your personal situation. I'm not going to use slides, given kind of the bigger picture and the time period that we have. And so I will go ahead and jump right in. So I want to kind of start with a comment about the past couple of weeks, and then I'll shift more towards a full and encompassing 2021 outlook. And the reason I'm going to start here is because I do hear, again, Brian mentioned those TV shows. I do mention here a lot of commentary right now about the market being disconnected from the current events in the current economy. I want to say again that I don't think it's a disconnect. I think it's about slightly different time horizons. And so the events of last week were a bit disturbing. We had a jobs report that was a bit weak. This morning, we saw jobless claims rise, which is kind of raising some concern. We've had increases in COVID cases over the past few months, and the market certainly pays heed to these, but I want to again remind everybody that the market is a discounting mechanism of not just what is happening today, but of the future. And so to me, that is why there can appear to be a disconnect when we have days where we get disappointing economic news, but the market moves higher. Importantly, for what we're talking about today, the market is painting a picture that 2021 will be much brighter than 2020 economically. And broadly speaking, we here at Northwestern Mutual agree. And so in the questions, we can dive into, in the Q&A part of this, we can dive into any one of these topics a bit more. But I think the reason why the market has been able to shake off some of this bad news is it doesn't believe it's permanent. So it does see a political system that will endure. I'll make some political comments here in a second. It sees an economy that has largely adapted to COVID. We will talk about that. It has certainly had an impact on your industry. People have shifted spending. Companies have figured out how to actually serve their clients in a COVID impacted economy. And most importantly, it does see vaccines that are coming in 2021 and will get all those people who are impacted right now, hopefully, back to work in 2021. And importantly, it sees fiscal stimulus. We had more and we have more coming. We'll talk about that here in a second. That is going to help build a bridge to that day for those individuals who are still impacted. And so to kind of paint just the initial broad picture, we do see in 2021 a US and global economy that will be operating on all cylinders of growth for really the first time since somewhere late 2017, early 2018. This is going to lead to fast economic growth. We see somewhere probably between 5 to 6% economic growth in 2021, early 2022. And the growth is going to be broad, which is important from a market perspective. We're going to talk about how I tie that into a market outlook at the very end of this. And so let me take you through a few of the supports that I see for 2021's economic outlook, drawing some important points that I think are very pertinent to you all. And so from a fiscal policy perspective, we do think that stimulus is coming. We have certainly had quite a bit of it, and we think we're going to get more of it. So if I take you back to 2020, in those early weeks of March, despite the partisan divide that is in Washington, we were able to quickly pull together the largest non-war stimulus program in the history of this country. It was around $2.2 trillion. We just re-upped that with another $900 billion. And this morning, it was announced that President-elect Biden is pulling together another proposal for $2 trillion more dollars. Now, I don't think he's going to get $2 trillion. I think he will get somewhere around $1 trillion. I'm sure we can talk about, and there'll be questions probably about what's the long-term impact, but let's focus on the here and now. I do think this is very important for a 2021 outlook. And so one of the ways that I think this impacts you all is that during 2020, economic growth fell. So overall, even with the strong growth that we had in the third quarter and the still strong growth in the fourth quarter, it's likely that 2021 will see economic output in the US shrink. Now, economic output is one way to count a country's well-being. The other is personal income. Think of it this way. Someone's economic output on the opposite side is someone's personal income. Personal income matters for the consumer. While economic output fell in 2020, personal income didn't. We're likely to end the year with more personal income for the consumer in aggregate than what was at the beginning of 2019. That is because of those very large stimulus packages that went into play early on, the ones that are continuing right now, and the reality that a lot of people have already come back to work because the economy has adapted. Important for 2021 is that we're getting more of it, but the ones that are already in the economy have not been spent. And so if you look at the consumer savings rate right now, it is somewhere around 12%. It will likely be higher because a lot of the stimulus that is being poured into the economy right now is actually not being spent. And so the consumer does have the ability in aggregate, I know there are certainly some individuals who are still impacted, but in aggregate, the US consumer enters 2021 in aggregate again on very decent footing. When you add in the low cost of debt, which is partly to do with the Federal Reserve keeping rates low, the cost of debt on the consumer's balance sheet right now is as low as it has ever been going back to 1980. And so when you put all those things together, I do think you have large amounts of consumer spending that will occur in 2021. And I think that is probably very important for your industry. Let me just make a couple of brief comments there on the housing industry in general before I pivot to monetary policy. Now, on a national basis, and Lesley is certainly more in the weeds on this, on a national basis, at least from the data that I have, housing still remains very affordable. That largely has to do with what I just mentioned about the cost of debt in this country. And certainly, I think mortgage rates are very important to that conversation. The US banking system, despite what happened last year, remains healthy. And so we spent 10 years after the Great Recession kind of cleaning up the banking industry, and it made it through 2020 in pretty good shape. And lending should begin to ease as you move into the year. Another way I kind of look at affordability is taking a look at a percentage of the mortgages that are being put into the economy. So mortgages that are either variable or fixed. Now, I know there is a lot of economic reasons why someone may do fixed right now, but I always feel that sometimes people stretch, perhaps if they have to stretch, they'll do an adjustable rate mortgage to get a lower cost of debt. I did take a look this morning, and I'm not for sure Lesley can fill in some details here if there's other things impacting this, but as of December, I believe the percent of total mortgages that are being used right now or being applied for is around 2% on the adjustable rate side. So not very many. On the dollar value of that, it's around 6%. That was around 50% back in 2005, where I feel like people were having to stretch for housing. And so I don't know, but I think this is somewhat speaks to some of the affordability that's out there too. And as I kind of just look, renting versus owning appears to be consistent somewhere with what it was over the past 25 years. So I'm not for sure that either has a huge advantage over the other, but perhaps there are some consumer preferences that may lead people still towards purchasing homes. I do think there's probably one minor headwind. Consumer spending that has occurred certainly has shifted towards your industry in 2020. Perhaps as things open up and people go back to traveling, maybe at the margin, there is some level of pent-up demand that may take some of that income that is still out there and have it used for purposes other than buying new homes in 2021. But all in all, I still do think that the backdrop, especially with the fiscal stimulus, the income that's coming, the consumer's balance sheet is pretty much a tailwind to your industry. One more comment on fiscal policy before I shift to monetary policy, because I know the question comes up about politics in Washington. And so while the Democrats do have control of all three chambers, I think it's important that it is still pretty much divided government. The control is slim. I think that makes any really progressive tax increases later in the year still pretty unlikely. And so I do believe in the House, the margin is 221 to 211, I believe. And I do know that there are at least 24 Democrats who were elected in highly Republican areas where there are a lot of wealthy people who do not want to lose in the midterm elections. And so perhaps there will be some pushback on any really progressive tax increases. I think the same thing happens in the Senate. And so I'm not thinking there's going to be a huge progressive tax increase, which, not a political comment here, could certainly cause some market consternation as well as some economic consternation. And keep in mind, there is, as I mentioned, a ton of stimulus on the opposite side of this. And that economic growth forecast that I mentioned does weave in some tax increases later in the year. The other thing I'd say from a market perspective, and one that I encourage all my clients to never do, and I have research on this, is that you should never overweight politics in your investing outlook. It is one variable we look at, but only one. There are certainly others. And I kind of sum it up by generally saying, look, presidents and administrations are pluses or minuses to economic growth in the US, not absolute positives or negatives. So if you think about the US economy, it's like a large tanker ship. It has independent people, independent business owners who are out making forecasts and doing things based upon things longer than 2 to 4 years, because we have elections every 2 to 4 years. Once it gets set in motion, it's awful hard to disrupt it from its natural trend rate of growth. And so please keep that in mind. My other research would suggest, especially from a market perspective, that what happens during a president's term is much more determined by when they take over in the business cycle. And so I can go back 60 years and show that when a president or administration takes office, what happens during their market to the market during their tenure is more impacted by when they take over. Do they take over early in the business cycle? Do they take over mid-business cycle? Or do they take over late business cycle? As you might expect, the ones who take over early in the business cycle typically preside over the highest market returns. And right now, the president who is coming in is taking over right after a recession where there is quite a bit of slack. And importantly, kind of transitioning to my second topic, there is a Federal Reserve who is going to continue to remain very easy into the future. And so I do think this is an important comment, both economically and from a market perspective. The Federal Reserve is not going to back away. The Federal Reserve has staked their credibility to getting inflation above 2%. The Federal Reserve has failed for much of the past few years, and they don't want to fail in the future. They want to try to do everything they possibly can to push the economy, let it run hot, let it run over 2% inflation, and they aren't going to hike rates anytime before we get there. The Federal Reserve used to hike rates gradually on the path to 2%. So they made the cost of debt more expensive. The Federal Reserve now is promising to not do anything gradually. There will not be a rate hike until sometime after inflation has averaged 2% for a sustained period of time. That is very important. The other thing I want to mention is the Federal Reserve, the way they impact the economy now is through the stock market. When the Federal Reserve does quantitative easing, when they go out and buy all those treasuries in the market right now, which is what they do because rates are at the zero bound right now, the reason they do that is so that they take those off your balance sheet. They give you cash. They reduce the stock of treasuries, which they hope you will actually go out and buy riskier assets. And so I wrote a paper on this. You guys can see all these on northwesternmutual.com. My Q2 market commentary, I wrote about the Federal Reserve and their new mandates. Bill Dudley, who is the former head of the New York Fed, wrote an op-ed, I believe it was in Bloomberg, mentioning explicitly what I just said, that the Federal Reserve's goal is to essentially get you to take risk. And so I think this is important from an economic perspective, from a comment about what rates could do in 21 perspective, and I don't think it's going to shift. The Federal Reserve is here to be a backstop for both the economy and the markets, and they will do so aggressively in 2021. That is not going to change until we get either too much inflation, the dollar falls too far, or interest rates rise too much. And right now, none of those three are on the cards in 2021. And so I think from that standpoint, you can suspect and imagine that rates will remain somewhat low and financing should remain fairly conducive. That's the bigger kind of economic impacts. I guess a couple other things to kind of add on top of that. You do have a manufacturing inventory rebuild that is occurring. I believe talking to some of you, you have supply constraints right now that have resulted from COVID. You have an inventory rebuild. As I talk to CEOs around our country, who drew their inventories down and are now having to aggressively rebuild those, which I think is really a tailwind to the manufacturing segment of the US economy. And there could be some inflation that results in 2021 from supply chain disruptions, but I want to caveat that I think that is temporary, and I don't think the Federal Reserve will react. You do have pent-up demand in COVID-impacted areas. Employment should strengthen. You have a consumer that has a lot of pent-up spending. And so I do think this all adds up to broad and fast economic growth with multiple levers. Before I stop and turn it over to Lesley for her comments, let me just kind of tie this more to a market outlook to kind of close out here. And so a more broader, faster economic growth to me means that the stock market does rise in 2021. Typically, if the economy's up, the market is up. It's fairly simple. But I think 2021 will continue to see new leadership because the economy is broadening from a position where it once was only narrow. Let me explain that here a bit using something called the Institute for Supply Management. At the beginning of each month, they come out with a manufacturing index and a services index. So a lot of times when I travel around, people say, Brent, what are the 2 indicators or 3 indicators that you feel give a good perspective of what is happening in the US economy? These are 2 of those indices that I think do that. So right now, both of these are in expansion. They're above 50. 50 denotes expansion. There are quite a few new orders coming in. Inventories are restrained. But I think the broader discussion, which I want to have, lies one level below. So there are 18 industries reflected in each one of these. So in the manufacturing, 18 industries, in the services, 18 industries. At the end of 2019, so pre-COVID, only 14 of the 36 industries were reporting positive economic growth. I take you back to the trade war that was harming manufacturing, both here and abroad. So if you think about it, manufacturing, that trade war was designed to rob global growth of one cylinder of its output, manufacturing, right? And it began to wash back a bit on US shores. The number of industries reporting growth fell to 4 in April. Think about my comment about COVID really impacting the economy. People didn't knowing how to go forward. Since then, the economy has adapted. We all have learned to do things like we're doing today. Companies have figured out how to serve their clients. By the end of Q2, 27 industries were reporting growth. By the end of Q3, 31 of the 36 industries were reporting growth. A couple points here. My first point on an economy adapting. Even with the recent increase in COVID cases, the number of industries reporting growth has only fallen back by 1 to 30. COVID is still impacting us, but it's a really narrow slice of the US economy, or narrower slice. The big industries that are not reporting growth, as you might imagine, are accommodation, think hotel, restaurants, along with entertainment and recreation. So my point number 1 is the economy has adapted. My point number 2, and more importantly, my point of a market outlook, this narrow economy did exist pre-COVID. So I mentioned the trade war. I mentioned at the end of 2019, only 14 industries were positive. There was a really narrow economy, not just in the US, but abroad. That narrow economy started back in mid-2018. This is when we were really introduced to the trade war. We really had it become a real thing. It really focused its lens on China. Keep in mind, as I mentioned before, that was designed to slow global growth. It was designed to harm manufacturing, and it had an impact on the US. But because the US has a huge tech sector, it was relatively unimpacted. US economic growth was able to grind forward, and it was really being driven by just a narrowing, or a pretty narrow slice of the US economy called technology. Guess what? Back to my comments about the economy and the market rhyming. The US stock market, at least US large cap stocks, have a huge percentage in, guess what? Technology stocks. And so when people talk about the S&P 500, it is not equally weighted, it is market cap weighted. And it has a large proportion of tech stocks. And so US large cap stocks, as well as the US economy, were able to grind forward because parts of both of those were relatively unimpacted. When COVID first hit, the same situation was magnified. Technology companies weren't impacted. They actually had a tailwind from all of us doing the things that we're doing today. This, again, was reflected in the markets. And so I'm going to give you some numbers here, and then I'll turn it over to Lesley to kind of tie this story to a close and then talk about how we see the shift occurring. These returns are from September 30th, when I mentioned the narrow economy starting, 2018 to September 30th, 2020. US large cap stocks, as denoted by the S&P 500, were up about 10% per year. Now, that was really driven by those big tech names. If I equal weight the S&P 500, rather than market cap weight it was only up around 2%. If I break the S&P 500 into growth stocks, think technology, versus value stocks, think industrials, financials, things that are more cyclical, growth stocks were up 16%. Value stocks up 1% per year. If I move further down the cap structure into small cap and mid cap stocks, both of which are impacted by economic growth being broad, small cap stocks were actually down 9%. Mid cap stocks were actually down 2% per year. International stocks, kind of the focus of the trade war, were only up 0.16%. This has begun shifting, and that shift began in September, right around the time we started finding out that economic growth was broadening, and we found out that a vaccine, if not many, which we have now, were on the horizon, which we think leads to broader economic growth. From 9/30 till today, I'm going to give you the same market returns, and realize these are not annualized, so the difference won't be as big. The S&P 500, large cap stocks, up still 13%. I'm not suggesting that these are not a good investment. They are, but I'm thinking that there are opportunities elsewhere. If you equal weight the S&P 500, it was actually up more, 22%. That growth versus value comment, value is up somewhere around 19%, growth only up 11%. Mid-cap stocks from that data today, up 31%. Small cap stocks, up 40%. IFA is up, our international stocks are up somewhere 19 to 25%. And so this is something of a rotation. We think it continues in 2021 because we think the economy continues to broaden, which really is a tailwind for those asset classes I just mentioned. And so to kind of close it out, the two things I would leave you with is one, if you're managing your own money, please don't undiversify your portfolios and chase things that have worked. I'm not suggesting they are bad investments for the longer term, but I do think in 2021, there are opportunities to kind of nudge in the other direction and pick up some incremental return opportunities, of course, all within a portfolio context. And so with that, I'm going to stop and turn it back, I believe, to Lesley to go through a more detailed outlook of the real estate market.
Actually, I'll jump in real quick. So thanks, Brent. Appreciate that. As a reminder, please submit your questions in the Q&A feature on the toolbar. We'll take all questions at the end of the program. And right now we have a familiar face to the TBBA. Please join me in welcoming Lesley Deutch, Managing Principal with John Burns Real Estate Consulting. Thank you for joining us today. And what are you seeing in the Tampa housing market?
Okay. I'm going to share my screen. Brian, can you see the screen? Yes. Okay. I'm guessing he's saying yes. Okay. Hello, everyone. It's really nice to be back. Thank you for having me. I always enjoy doing the economic forecast for the TBBA. So let's just jump right into it. For those of you who don't know who I am, I'm a managing principal here at John Burns Real Estate Consulting. I manage all the consulting assignments across the East Coast. I also write our company's apartment reports as well. And we're a combined research and consulting company. So we've got hundreds of subscribers who receive our weekly, monthly updates, but we also are doing consulting assignments really across the country. So those two combined really give us some great knowledge of all aspects of the housing market. So what I thought I'd do today is I'm going to review our outlook for the US housing markets just overall in general, focus in on the state of Florida, and then zero in on Tampa. By the end of the discussion, what I thought I'd do is provide you with some trends or hot topics that really I think are here to stay, that started during COVID, during this pandemic, that are here to stay and will help provide a competitive advantage to really everyone, builders, developers, owners in the future. So with that, following up Brent's discussion, we have a very bullish outlook for 2021. And those of you who know me and know our firm will be very surprised to see something like this. Usually we're a little bit more on the pessimistic side, but the outlook is very, very strong. I'll go through why we think that. So we think there's going to be strong housing demand, just like we've seen in 2020. It's going to come from the home primary home buyers, but also from investors and from rental households. Supply is going to be low. So there's low supply on the new home market, but also on the resale market. And that will provide some difficulty in the future. And I will touch on that. But also the bullish outlook is also from the increasing optimism that the vaccine will allow the country to return to normal, at least by the end of the year. So I provided our 2021 forecast. And again, this is for the US right now, and I'm going to get into Florida and into Tampa as well. But breaking down our US forecast, we're projecting 8% resale home price appreciation, which is really far above the consensus forecast, which is about 3%. We actually believe resale price appreciation could trend even higher. And that's due mostly to investor activity as well as homebuyer activity. New home price appreciation, that number is high, 9%. But that's really driven by that tremendous lack of supply and the need to drive down sales activity so construction can catch up. The rental market has a little bit of a mixed story. So we analyzed both apartments for rent and single family rental. The apartment market is a mixed bag. So there's suburban growth in the apartment market. There's some urban decline as well. So overall, we do expect effective rents to decline 5%. This is on the US level. This is primarily driven by the urban markets that are really seeing some serious rent declines at this point. The apartment market's at a 32-year high of supply of new construction. So, and this is just market rate only. And many of these units are really going to hit the market in 2021, which is really going to hurt rent growth in certain markets. Not Tampa. While I'm here, I'll qualify that. But the other hand, then we've got single family rentals, and we have a 3% projected increase in rents for single family rentals. But we think there's some upside potential here, and we're continuing to look at this forecast, and we could revise it upwards. There's really high occupancy rates and very low oversupply issues that don't affect this market the way it does affect the apartment market. So then I'll move on to home sales growth. So we forecast a 7% new home sales growth, 9% single family permits and starts. Consensus out in the market is for a lot higher growth than this, but I think there's some downside potential in this home sales figure and the permits figure, because really not only has a lot been pulled into the fourth quarter of 2020, but builders don't have the supply to sell. So actually our sales forecasts across the country are a lot lower than some of the consensus numbers, but it's really more of a supply issue rather than a demand issue. We do have a strong increase in resale sales, about 15%. And there's a lot of investors as well as home buyers interested in that market. For the multifamily side, we have a big decline in permits. That multifamily, like I said, has just been under a construction cycle. And same with the starts, is a big decline here. So the assumptions behind the forecast, and this is important because the market is changing and ever changing. We do assume 2.9% mortgage rates through 2021. That is incredibly low, and that is helping affordability. This forecast is not necessarily our forecast. It's based on how the bond market futures are trading. Rates are going to continue to be low. Fed intervention that Brent talked about before is going to keep the mortgage rates low. And there's few signs of inflationary pressure. What's important about the low mortgage rate, though, is that it's going to keep the median housing payments to incomes at about 32% nationally, which is above the 29% historical average, but it's well below the 2006 numbers, which were around 39%. So again, affordability is going to get pinched a little bit with the rising home prices, but the low mortgage rates are really offsetting a lot of that. The economy. So we do expect an improving economy. We're projecting 3.6 million jobs gained in 2021. That's a 2.5% year-over-year growth rate. At this level, by the end of 2020, the US economy would have recovered about 71% of all the COVID recession jobs lost. So right now there's 6.7 million job openings, which is much higher than usual, but it is a good sign for the future. Quality of labor has returned as a big problem for companies as they return, especially for small businesses, as they return back to business. The buyer shifts. We do expect continued shifting in buyer preferences, and I'll expand on this and how this can affect home buying. But really, the work from home trend, we put some numbers behind it, and we do expect about 9 million more people will be working from home at least one day a year after COVID is gone and behind us. So that has a big effect on the home buying market for bigger homes and where you buy your homes. And so we think that trend is really a shift and not necessarily a short-term trend. And it's going to push home buying, it'll continue to push home buying activity outside of the core urban areas. And finally, behind our forecast are the loans. So we do expect a high success rate in delinquent loans, in modifying delinquent loans. That's the stated intent of both the FHA and the FHFA. So 5.5 mortgages are currently in forbearance, and we expect some consideration of delinquent student loans as well and some modifications there. All right, now let's go on to the fun part. We're going to move on to Florida. I tried to think of all the positive things I could say, but really Florida's booming. I'm going to start with our master planned community survey that came out last week. And so what we do is we survey all the large master plan communities across the country. The sales numbers, if you focus, I know there's a lot of little numbers here. This is free on our website, but you can see the growth rates of some of these master plans. So 6 Florida master plans made the top 25 list, and about five or six others are actually on the top 50 list. And so I'm going to mention the 5 or 6 others because we've got some Tampa members here. Babcock Ranch, Starkey Ranch, Ave Maria, Bexley, and Rivertown also made the top 50 list. So the sales rates on this list are worth looking at because they are just outstanding. Lakewood Ranch is in sales were over 2,100 home sales this last year, 2020. That's a 30% increase over the previous year. So clearly this has been a very popular area for people to move. We rate all the Florida housing markets every month. This is a combination of what we hear from the builders, statistics that we compile, and then me and my team traveling around the state. The dark green here is very, very strong. And then a normal market, just to set a base, would be a market where you see some small, modest price appreciation and steady but slow sales. And you can see those markets, especially Fort Lauderdale and Miami, are land constrained. But the very strong markets, the Tampa and Sarasota markets, are really seeing over 7% price increases. You're seeing 5 a month, and builders are holding back sales, holding back lot deliveries because they want to continue to take advantage of the price appreciation. So these are 2 very, very strong markets, but really across the board, all the Florida markets are benefiting. I do have to say employment isn't great. People know that. It's getting better, and we do have positive forecasts, and I'll go through those for 2021, positive gains, just not back to where we were. This is a current, it's the last 12 months of job losses by market, followed by the unemployment rate. So you can see markets like Orlando are really still suffering from the job losses. Now, most of these are lower wage jobs. They're in retail and hospitality, but this is going to be, a slow grind back to where we were. So this will have an effect on all of these markets across Florida. But the good news coming out of this is the relocations, the corporate relocations. I'm a native Floridian, so I love when this happens. This makes me feel good that we're getting some real employers here in Florida and some strong employment. And granted, they're coming to Southeast Florida, but we think this might really benefit the whole state. So far, now Colony Capital announced too, I didn't even get a chance to do that, but Blackstone, Elliott, Goldman Sachs, they're moving to Miami and to West Palm. It's really a good sign for the state's economy. And just a personal story here, I spoke with a colleague at Elliott Management who said, once the announcement came out, he has never had more LinkedIn connections from brokers, from home brokers, and from yacht brokers than he's ever had in his life. So the industry is that the local industries are very aware of the people moving, and they're after them. I didn't realize that, but I thought that was quite interesting. We also look at migration by U-Haul statistics. So a lot going on in this chart, and I'm going to explain it. That the statistics here measure the average cost of taking a 20-foot rental truck to a market, to another market, less the cost of returning it. So if you're positive and if you're green, that implies you're seeing net in migration to an area. If you're red, that means there's net out migration. So the dots on this are showing what the premiums were last year. So you can see that the premiums are really growing. And I'll just give you an example because Portland's an interesting one. The premium is now less than it was last year. So it's signaling that the migration is really starting to slow. But in all the Florida markets, you see that the premiums are much higher than they were last year. So we've got 5 Florida markets on this premium list if you can't see it. Jacksonville hits it right up at the top, followed by Fort Myers, Sarasota, Tampa, and Orlando. We do a builder survey every month. I mentioned before, new home starts are rising. They could be much higher than this, but they're really being constrained by the land availability and builders like slowing the lot releases. And so to talk about the land constraints, this is a real issue. This chart shows you community counts, and I think it's really jarring to look at it. This is every quarter we go and we count how many communities are there per builder. That has been increasing for many, many quarters. And since COVID really hit, you're starting to see the decline. And that's because builders there isn't enough land and you're starting to limit the sales in your current communities. So I think this is going to be the holdback to our forecast for stronger sales growth. There's just not going to be the inventory to sell, or the inventory is going to be selling a lot slower due to the builder's choice here. Okay, moving on to Tampa. Tampa, I have to say, since the beginning of COVID, has been sort of the outlier in a very, very positive way. It really outshone almost all the other markets in the country. The only other market I would highlight with Tampa is kind of bucking the national trend would be maybe Austin and Salt Lake City. But Tampa really recovered immediately in the housing market and even to see the relocation. So, well, let's go deep into Tampa for a minute here. Single family permits are rising. I think this is important to see this. It's not exploding, but they are increasing. So residential permits overall are down 11%, but that's driven by the apartment market. That's the light blue on this chart. But the single family permits are up 8%. So you can see the growth in Tampa prior to this, but really started to expand really most recently. This is the same chart that I spoke about last time about the lack of communities. So this is just Tampa alone. And what I've done is broken out the public builder communities in the dark blue and the private builders in the red. But overall, if you look at the total trend over the last couple quarters, the number of communities open has started to decline. Builders are selling out of their current communities. And that's really going to slow the sales pace. You know, it's going to prevent a faster pace of sales. So the new homes, it has low inventory. Look at the resale homes. There's 1.2 months of supply. That's virtually nothing. Now that's driven by demand from people moving to Tampa, moving around Tampa, but it's also driven by investor demand. So there's, I could do a whole webinar about build for rent, right? But there's a lot of investors in Tampa and single family rentals like American Homes for Rent, Progress Residential, Invitation, Tricon. These are big national companies coming in and buying up all the resale inventory in Tampa, fixing it up and putting it back out into the market as rentals. But it's really constraining the for sale side. So there's no resale inventory and the new home inventory is really constrained. So you can guess what that leaves us with is some pretty rapid price appreciation. I want to point you to the dark blue line here on this chart, and you can see that the growth, that's the resale market, is really starting to appreciate because there's just no supply on the market. And in fact, it's coming pretty close to the new home, which is around 294,000 right now. But the new home market, that's part of the reason we're going to have really strong appreciation in Tampa come 2021. And I'll touch on that in a second. But despite that, you would say that that's going to cause a major crunch in affordability. But take a look at this. I put pouring fuel on the fire here. FHA just increased their loan limits. So now in Tampa, on average, the loan limit for FHA loan is $356,000. Look at the median new home price and look at the median resale price. That makes Tampa a relatively affordable market still, given these low interest rates. So despite that increase in home prices, and this is why we've got a strong home price appreciation forecast, there's still room to push prices as long as you can stay well under those limits. And there's really a lot of push here to go. Okay, so what I thought I'd do here is give you our 2021 forecast, and I will make these slides available if you want to email me afterwards, or we can go through TBBA. So I just want to give you a heads up for that. But here's our 2021 forecast. So employment in Tampa, we expect to be up 1.9%. That's a gain of about 25,700 jobs. You know, we lost 40,000 plus last year, so that's about half. So we're coming back. And this is similar to where we see most of the markets, really improving, but not gaining, about 60–70% of where we were. The income levels we expect relatively flat, about 57,000 on median income. Affordability, put this one in red, and this is something to watch, no doubt. We do a scale of 0 to 10, 10 being the most unaffordable Tampa has ever been based on the median income and the median home price. So Tampa's going up to a 9.1, but again, factoring in the low interest rates and the FHA raising their limits, that really, that really does help Tampa's affordability, although it's something to watch for sure, especially on a case-by-case basis. Construction, we've got total permits down 1.5%, but that's again driven by the multifamily side. Single family permits are up 6.5%. I double checked that number a couple times because you'd think it would be higher, but really overall it's being constrained, like I said, by the land availability and the builders holding back the sales. 9% median new home price appreciation in 2021, and 5%, 7% new home volume increase. And the resale market up 7%. There's upside potential there as well. We do expect that volume to increase as more listings come on the market. On the for rent side, we've got apartment rent down 4.3% on average, and single family rents up 3.4%. So that's our overall Tampa view. Here's my words of caution, because I wouldn't be a good economist or person, right, a researcher, if I didn't have, wait, just be careful. There is some cautionary tales here, and I keep coming up with new ones, but right now the market is great. But I do want to talk a little bit about affordability. I mentioned that 9.1 out of 10. Home price increases. Tampa is a relatively service-based economy, back office jobs. I would just say, although the median home price is very affordable right now, just watch some markets and some areas. I think affordability will start to really impinge on market growth, maybe not in 2021, but going forward, that's definitely going to be a concern. The economy presents all kinds of risks, right? We've got this artificial economy boosted by government stimulus, which we just heard from Brent might be even more. There's record high auto and student loan debt. There's record high job losses still. And you saw the chart that I showed you about the job losses. And there's still 20 million, I didn't update that this morning, but 20 million people plus receiving unemployment benefits. So there are risks out there. And there's also local market risks too. And Jennifer talked a little bit about this, municipality delays and impact fees, construction costs. Lumber continues to spike here and there. So it's definitely a big concern. There's going to be increased competition. Florida's growth is no secret. And there are builders coming in saying, wait a minute, I see Florida growing, and there's other markets that are growing, but not nearly as fast as Florida. So that pushes money and pushes other builder presence. So you're going to have more competition. You're also going to have to build for rent. You're going to have more investors coming into this market. And then finally, on the risk side, I just want to say 2020, and maybe 2021 might be good, but that's not the norm. So this chart shows you the year over year sales rate per community. I mean, this describes COVID in the housing market in one chart. Look at the growth numbers year over year. That's going to be hard to beat. So if you're out there buying land based on your sales rates from 2020, that's a pretty hard comp. So believe me, it's getting harder and harder to do market studies because you don't want to base it off the last couple months of sales because that's not normal. That was driven by the COVID, by the pandemic. So just keep that in mind as you move forward and plan for the future. Okay, so the fun part of this is I'm going to jump through some of the trends. When I say trends to watch, these are trends that, come in April and May. We started to see these trends happen and we said, all right, well, maybe it's just a temporary trend and it's not permanent. But these are the ones that I think are at least going to last for a few years, that if you start to follow these trends and watch them carefully and take advantage of them, it really should provide a competitive advantage here. Build for rent, the hot topic of the day. This is in Sarasota. This is Estia, Lakewood Ranch. This is here to stay. There is a lot of institutional capital chasing this. Both builders see the advantage of it, and so do apartment owners. So see more and more national regional apartment owners getting into this business. These are 700 square foot 1-bedroom units and about 1,000 square foot 2-bedroom units. They've leased up at 34 a month. Lots of snowbirds coming in, just having a place to stay in Florida. It's been a true success. And I think you're going to see, and you are seeing more of it in Tampa, but you're going to see even more of it. So it's something to watch either as an opportunity or as your competitor. So I think this trend is certainly here to stay. And the demographics really promote it as well. Work from home, like I mentioned, 9 million more people will be working from home. This is an advantage for builders and for apartment owners to be creating those spaces in your models and talking about your models as a having an extra room for an extra workspace. So I don't think there's a huge shift for the owners here, but it's something to be aware of that's in the consumer's mind, and really all consumers. Multi-gen living, I think, is a trend that's here to stay. And multi-gen can be your mother-in-law moving in with you, or it could be your adult child moving in with you. Almost everybody had that experience. A lot of people had that experience during this pandemic. And I think they're starting to reconsider their living arrangements. And it doesn't have to be a full second kitchen like I showed you here. It can just be 2 master bedrooms in houses. So I think there's going to be a lot more demand for that going forward. And finally, outdoor living. So outdoor living has always been popular, but not as nearly as popular as it's going to be and has been over the last year. And by outdoor living, I'm saying outdoor living within your community and outdoor living within your home. So that is something that a lot of builders and even apartment owners haven't really focused on in terms of showing models and showing the opportunities. And I think that's going to be a real competitive advantage because, again, nearly everyone went through this pandemic, and being outdoors was really helpful for a lot of people. And it's really become, I think, much more of a permanent trend. It's just something that consumers will be eyeing even more and more into the future. So with that, I covered a lot. I will stop sharing my screen. I'll turn it back to Brian. Thank you so much.
All right. Thank you. Let's move to questions. And Lauren, can you moderate that for us?
Yeah, absolutely. Let me just share my screen real quick. Boom. From current side. All right. So we have a couple questions that have come in. Again, you can submit your question in the Q&A feature on the toolbar. The first one comes from Justin Carpenter, and this probably goes to Lesley. And I think you touched a little bit on the land supply, but many builders see land as an issue going forward, finding land and the cost of land. Do you see that continuing into the future?
Yes. I think that's going to be one of the biggest constraints to growth. I think I did touch on that a little bit, and I certainly think that will be a big constraint to growth. But I also forewarn that don't buy land based off of your sales in last year. That's important too. So that there is going to be an impasse, and that will constrain our supply and raise prices.
Great, thanks. Blake Lindsley, this is probably for Brent, as well as the next question from Scott. Brent, can you see that, or do you want me to read this all
I can
out?
see it.
Okay,
No, I
go
can see
ahead.
it. No, look, I think inflation is eventuality. People ask me and I was asked on one of these calls, what would be your what would be the recipe for creating inflation? And to me, what we're doing right now is the recipe. And so I mentioned the aggressive fiscal policy in the US. That happened around the globe, even in places like Germany, where prior to this, they were really reluctant to do anything like that. You have the Federal Reserve, who completely shifted. They've done a complete 180 from what the Fed used to be. So if I take you back to the 1980s, Paul Volcker came in, taught the Fed how to fight inflation. They followed his recipe for 40 years. And I know a lot of you follow the Fed and know they have a dual mandate of employment growth and inflation. But really, for the past 40 years, they've had one thing they chose to focus on, which was never letting the inflation genie out of the box. That was the big boogeyman. If I take you to today, that has completely shifted, and now they are committed. There were some holdouts on the Fed. They rewrote their policies in 2020, and I think you will eventually get a period of inflation that will, at some point, not this year, but at some point will cause the reckoning that I think people are asking questions about often. How do we deal with the national debt? When do interest rates go? What's the cause of the next recession? I do believe that's it, but we're not there yet in 2021. And certainly we have some room to go before then.
Great. And Lesley, I know when we talk about Tampa Bay, sometimes Manatee, Sarasota, Hernando County sneak in there, but on your slide specifically, are you talking about Pasco, Pinellas, and Hillsborough, or are you far reaching?
No, Hernando, Pasco, Pinellas, and Hillsborough. That's it.
Okay, excellent.
Not Sarasota, yes.
Art asks, what is your opinion on the luxury market? That's probably for you, Lesley.
Sure. It's great. I actually had a slide that I didn't include here that really shows that this pandemic has really, it's benefited almost every segment of the Tampa market. So you've seen the entry level, the move up, and as well as the luxury market. So I have a very positive outlook, and it's an unusual time where you can see all three segments really booming. But there is demand on all levels. And so I've seen that not only in Tampa, but really across the Southeast. So a very positive outlook for sure.
Great. And Ron Weaver with Stearns Weaver, these two questions are probably for you, Brent, talking about Biden's infrastructure, if you have a comment on that.
I don't know. I mean, I haven't seen the bill proposed yet, and so I don't know if it's going to help builders or not. And so I guess I don't know. Lesley, do you have a comment on that? I don't know that I've seen. I do think you will get some sort of an infrastructure bill. I think typically a lot of these, the economic agenda gets put out somewhere around August. And so that's one of the areas where I think there could be a bit of a market upset, because while I mentioned that there may not be large tax increases, I think there will be some proposed to pay for what he's looking to do, which could cause a bit of a market upset. But I don't think it goes through just for the reasons that I mentioned before. I guess one thing I didn't address, the tariffs on China. And so I think being tough on China and pulling manufacturing back to the US is bipartisan. I don't think doing it via tariffs is in the cards for the Democrats in 2021. And so I don't know that they come off immediately. He said he will review those, but perhaps they are tied to other developments that may be more friendly. And so I don't think you're going to see an increase in tariffs. I know that he's reviewing them. I don't think they come off immediately, but perhaps as you move throughout the year, as other things are hit, as they tie it to other positive outcomes, you do see some of those come back off.
Great. And Jennifer, this is Randy Robertson, longtime member. He's asking if there will be a shutdown in residential permits in Hillsborough in the near future. What do you think?
No, not that I'm aware of. Everything that I'm hearing is specific to zoning, not building permits.
Great. And then we had a couple of questions come in the chat feature, but I'm not showing. There we go, chat. Let's see. Laura Bartholomew asked, what impact to the forecast is anticipated once the foreclosure and eviction ban is not extended? Lesley, I know you touched on this a tad bit, but can you expand on that?
Sure. So I do expect it to, although I'm not a government watcher, I do expect it to be expanded. If it's not, if it's not, we are going to have a serious problem with affordable housing, which is a whole nother topic, which I've been researching tremendously. So I think there is a whole nother world right now focused on what do we do with sort of the people that are going to be evicted and that can't afford market rate apartments. And the good news is there's a lot of private capital and private money focused on this. The bad news is it's not going to be a good situation. But so there are solutions, and there are people focused on finding those solutions and getting ready to implement it. I don't think it's going to affect market rate housing as much as it will affect the affordable sector.
Brian, you have a question. Talking about manufacturers are rebuilding their inventory levels. Any idea how many quarters that will take for housing goods?
Unfortunately, I don't, Brian. I haven't looked at that level of detail or I dug really into the survey to see if it can actually predict that. I guess let me get back to you on that. I know that we have a mutual contact. So let me see if I can formulate some type of an opinion on that for you, if that's okay. Perfect.
Great, and I believe that concludes the Q&A. If any other questions come up, please feel free to send them to the TBBA staff, and we'll do our best to connect you with the appropriate person.
Okay, great. I want to thank everybody for participating in today's program. I think it was excellent. Lesley and Brent, thanks for joining us today, and we really appreciate it. So
thank you.
Thanks, everybody.
Thank you, everyone.
Bye.
Thanks.